Good afternoon. My name is Dennis Brooks. I'm a graduate student here at the University of Alabama in Birmingham. I work in the Colott School of Business Tutoring Lab. We're going to study Chapter 12 of AC 200 today, which is reporting cash flows and primarily concerns itself with cash statement of cash flows. You can reach us here at the Colott School of Business Tutoring Lab at Colott Tutor Lab at uab.edu, or you can arrange for Skype sessions at Colott Space Tutor Lab on Skype. And again, as I said, we're going to discuss reporting cash flows on the statement of cash flows. The purpose of this statement is to report cash receipts inflows and cash payments outflows. This allows you to discover where your cash receipts inflows are coming from and where your cash payments outflows are going to, which allows you to analyze, are you getting your cash from operations, from financing, or investing? How does your company receive its money and why? Where is the company spending its cash and why? And why is this company spending its money here or there? The statement of cash flow does this by analyzing, classifying, reporting, and summarizing where its cash is coming from or where it's going to. Measurement of cash flows. Cash flows can be both cash and cash equivalents. Investment securities or debt securities typically within 90 days of maturity. Operating activities are the activities that help you to convert assets into or liabilities that determine the company's net income. These are the day-to-day business activities that your company takes to generate revenue. In your income statement, these are typically entries that operate or that occur above operating income. You'll see what I'm talking about in a minute when we talk about the statement itself in more detail. Financing activities are typically activities that affect your company's equity and its long-term liabilities. For instance, selling a notes payable, the infusion of cash from the sale of a note payable, and the subsequent payment of interest and the final repayment of the note payable are financing inflows and outflows. Investing activities generally affect long-term assets such as plant, property, and equipment, or PPE, or specifically the buying and selling of such, but they also include buying and selling short-term securities, the issuance of notes receivable, and the cash flows that proceed from that. An example of an investing activity might be the sale of land or equipment if that is not your normal mode of operating activity. One very important thing to remember here is that an activity can change from one type of activity to another depending on what sort of business your company operates as. For instance, your company is a retail furniture store. So if you sold some land, that would not necessarily be an operating activity. But if you were a realtor, that would definitely be an operating activity because that's how you made your money, is by selling land. Non-cash investing and financing. It is important to know that not all investing and financing activities are going to include cash. When these activities do occur or are incurred, they are disclosed in a note at the bottom of the statement of cash flows or in a note to the financial statement. For instance, your company buys a new piece of equipment and issues a long-term notes payable in the place of cash. The journal entry would look something like this. Equipment would get debited, which means increased, by $125,000, and you would issue a notes payable or increase your liabilities by $125,000, which would keep the integrity of the accounting equation whole. As you always know, all debits and credits always have to equal up. No cash exchanged hands, but it would still be considered an inflow in the acquisition of the equipment and an outflow in the case of the issuance of the notes payable. This would be considered a financing activity. The statement of cash flows are a required part of a company's financial statements, and it will show the provenance of all cash inflows and outflows and separates them into three main categories: operating, investment, and finance. If inflows or outflows are positive, it will say net cash provided by whatever type of inflow or outflow it was. If inflows or outflows are negative, it will say net cash used by operating, investment, or finance, whichever type of inflow or outflow that it was. Preparing your statement of cash flows. There are 5 primary steps to preparing the statement of cash flows. Compute the net increase or decrease in cash. Compute and record net cash provided or used by operating activities using either the indirect or direct method. Indirect method and direct method will be explained later. Compute and record net cash provided by or used by investing activities, provided or used by financing activities, and then compute and record net cash flows by combining operating cash flows, investing cash flows, and financing cash flows. Then you must prove it by adding it to beginning cash flows and it being equal to ending cash flows. The direct method lists each major item of operating cash flow, of cash inflows, and each major item of cash outflows. The outflows are then subtracted from the inflows to arrive at the determinable amount of operating cash flows. Indirect method takes net income and then adjusts aggregated amounts of inflows and outflows to arrive at the determinable amounts of inflows or outflows. Now, there's a kind of important little note here. It is important to recognize that the FASB, the Financial Accounting Standards Board, prefers the direct method, but since there is not a requirement for companies to do so, most companies prefer to use the indirect method as it is an arguably easier way to compute the proper balances. However, it is important to note that the exact same balances should be expected to come from the usage of either the indirect or direct method. Okay, so we're now done here. We're going to go over here to an Excel problem. And basically, all I'm going to show you here is a pro forma statement of cash flows using the direct method. Again, we're the Brooks Incorporated statement of cash flows for period ended 12/31/2014. That can be December 31st, 2014, or whatever dating method they prefer. So you would start with your beginning cash flows from operating activities, and then you would have a list of individual inflows and outflows, and then you would total those for a net cash provided or used by operating activities. Cash flows from investing activities, again, list of individuals' inflows or outflows. You would net cash provided or used by investing activities would go there. And you would continue down this until you had your final cash and cash equivalents balance at current period end. And your beginning period end here, plus your balance with your net cash, net increase, decrease in cash, should then equal that. Separate schedule or note disclosures of any non-cash investing and financing transactions is required and would be somewhere down in here. Now, one ratio that I did provide is the cash flow on total assets ratio. Cash flow on total assets equals cash flow from operations, that's up here, divided by your average total assets. That means your average total assets for the year. That means you take your beginning assets, your ending assets, and you average them out. Again, my name is Dennis Brooks. I'm a graduate student here at the University of Alabama at Birmingham in the Collab School of Business Tutoring Lab. You can reach us at any time at colottutorlab@uab.edu, or you can reach us on Skype at colot space tutorlab, one word, on Skype. Thank you.